Welcome back to the black hole of real estate. I'm excited to bring some news to you that's a little bit different than we've been sharing recently, and it has some pretty interesting news regarding interest rates, what the inventory levels are doing, and a little peek at the forecast for the rest of the year and what might be different this time. And maybe at the end we'll talk about if sellers are still terrified or not. So I guess we're going to have to address that as well. The first thing is that the interest rates, we thought that they were going to move. We got a little curveball, and now there's going to be some Fed meeting. Interesting things going on right now. My suspicion is we're going to get those interest rate reductions that we thought would have come sooner and more often since last November. I was very clear in the record. I thought that November of 23 would mark the time where rates would come down almost every meeting until the November elections, and it didn't quite play out that way. And I can't give you a good reason why, so fake me out a little bit. But now I do believe they're going to signal that there will be steady rate drops, at least 2 or 3, probably a quarter point each between now and the end of 2024. And it's going to bring a little affordability back in for some of the buyers that were financing and shut out of the market. Now, the market didn't come to a standstill because it feels like at least half these deals that are going on right now are cash. But for those that were looking to finance, the arrow's probably pointing up for them between now and the end of the year. And with the proliferation of these interest reduction programs where you can refinance down the road and save a lot of fees, I think there's going to be a softer landing for most buyers than some would have thought. I think we've let go of the fact that we're probably not going to have 2 and 3% interest rates ever again. But historically speaking, 6 and 7, even 8% were really solid rates over the time, the last 50 years. I think we'll see that we are below that area when we get down into 5s. I think it's a pretty safe bet we'll get back into the 5s. I'm not sure we're going below 5 though. So arrow pointing up for rates going down. What's more interesting is the steady climb in inventory. And it doesn't mean that prices are ready to drop dramatically because there's too many homes on the market. It's going to take a long time for the inventory to satisfy the buyer's appetite. I think nationwide we'll see the 5 million sales again that we've been hovering around for the last 5-10 years. I think that's going to be a thing this year once again. But I also know that with more inventory going to be out there, buyers have choices. So where sellers were hesitant to go on the market in the past few years, I think because there's more options available to them, there'll be a little easier decision for them to actually go back on the market. I think the simple fact is I think most sellers have waited long enough, watched interest rates spike up, and they have stayed put since COVID. I think they're just ready. And whether they're upsizing or downsizing or getting married or divorced or retiring and getting a vacation home or any of those things, I think they're ready to move. And when you're ready to move, the interest rate kind of matters less. When rates in the early 80s were 18 and 20%, there was still a way for people to move. There was massive buy downs of interest rates. We've seen a lot of those mortgage buy downs this year. 2-1 buy downs are a big thing, and those are happening with the credits. There's a lot of reasons that the inventory is creeping up right now, and I believe that will also help some more selection, better rates. It's on a horizon, so between now and the end of the year, I think you'll see steady sales. We mentioned 5 million home sales. I think that's a real thing. There's still a big appetite for vacation homes and beach homes. We continue to see a softening in the short-term rental market, those Airbnb types. And that is because the revenue's down. There's competition from the hotel blocks, and so they're really pressuring these short-term rentals margins. And I think that's going to affect some pricing along the way. Multifamily property is definitely doing well right now with the rent rates such that they are. We're seeing where the pricing is starting to line up a little bit better on multifamily projects. I think that's something to watch for if you're on the investment side of things. What's getting really interesting, though, is condos. And as we see more and more enforcement of the laws to make sure these buildings are meeting the construction standards that have been set forth since the disaster down in Miami, that's wreaking havoc on some of these condo buildings. And it's not necessarily the government who's enforcing it. It's actually the insurance companies that are playing the biggest role. You see, insurance companies like to make money, and when the risk is too great, they either have to make an adjustment in the premium upwards to make the profit they need, or just not write that product. And that's what we're seeing right now. So in Florida, you've got Citizens Insurance, and if the roof doesn't have at least 5 years of lifespan left that the insurance company and Citizens agrees with, then the property becomes uninsurable at favorable standards to the condo associations, or at all. They're just dropping policies. And I'm familiar with one right now that's with less than 100 owners that has a membrane style roof that has 5 years, certified by two different engineers, and the insurance company is rejecting that. So this particular association is going to have to pick your poison, good, better, best. Spend $500,800 or $1.1 million to redo the roofs. They've only got a few months to do it. The insurance is out, so it's a big problem. And when you start looking at 5, 10, and 12,000 per unit in small buildings, that is going to trigger some people to just write a check and pay it, others to borrow some money or use a pay plan, and others just try to sell. So when those properties do get sold, that would be an opportunity for someone who want to capitalize on this misfortune that has some cash. I think those buyers could go in a situation like this and buy a condo that's going to be somewhat undervalued than it might have been before this assessment would have hit due to the roof. Now, ultimately, I believe that someone's going to buy into this, and once the roof is done, and let's say the balcony projects were also done, that association probably has little or no big on the capital expense size. There's very little left. It's landscaping, maybe. If there's no elevators, that gets knocked out of it. So if you've taken care of walkways, balconies, and the roof, not a lot left to assess on. So I believe what you'll see is that one will have a slight dip and turn in the future. So if you look at the condo market and you see this assessment thing going on, what you have to understand is sometimes the insurance is not replacement costs anymore. And if you were getting a loan and there was replacement cost and there was insurance, no problem. But when the replacement cost insurance is replaced with something less expensive, and let's say the owners got hit with a $12,000 assessment and they don't want their monthly dues to go from like $600 to $1,000, they might, well, let's get a cheaper insurance. What else can we cut back on? Sometimes the insurance policy put in place is such that banks won't lend on it. See, that's the other lever here. So if there's not replacement cost and the bank is saying, well, geez, what our collateral is not covered because there was catastrophic damage and you can't rebuild the condo, how do we get our money back? The collateral. How does the bank get their money back? So the only way they can ensure that is to have much, much bigger down payments, much higher interest rates, or just not write any mortgages in that building. There's no mortgages being written in the building. You've now created a situation where the properties can only be sold as cash-only sales. That could also affect the pricing. So the dominoes are in play right now. Something terrible and catastrophic happened in Miami. No way to ever really fully address the pain and the loss with that. But the aftermath is that these buildings will become safer. There will be a cost to that. Absolutely. But as these balconies and roofs and things are in better repair, there'll be a cost. Some people will just pay it. They'll have the money, they'll just pay it. Some will take loans, additional expenses. Others are just going to sell. It will affect pricing. And the insurance is the key player in all of this, as I said. So watch for this. It's a really big issue out there, and it's getting louder in the landscape. So condos, repairs, insurance, and safety, all in one. The last thing I want to bring up right now is, are sellers terrified to go on the market right now? I think the answer is no. 3, 4, 5 years ago, whatever it was, the COVID times, man, you knew your house would sell in a nanosecond. And then you would have like a week or two to pick the least worst option of the couple of homes that were available, knowing that you sold a home that was pretty good and probably better for you than one you're about to buy and pay a premium on and pay a lot of commissions in between. So at this juncture, We're not in a situation where buyers have to give up every liberty. We don't have to bid above the asking price by 100 grand, and we don't have to give up the inspections. Contingent deals are working right now. You can write in there that I'd like to pay less than the asking. Have a 10 or 15 day inspection period. I make a contingent on the sale of my house. And those deals are starting to work right now. So the fear of a seller going to market, that barrier is much, much lower. And as that happens, it gets easier to go on the market. So the inventory solution is on the horizon. The rates will get a little bit lower. That will help some of the buyer appetite in here. But we are in a deficit situation where new construction played a huge role. I mean, in some areas, 30-40% of the market. There was such a shortage of homes back in 2017 and 18 that it just happened. There wasn't enough homes to go around, and it lasted a super long time. Well, we're starting to level out in that area just a little bit, and it should help some buyers get more home. It'll help sellers be able to actually think about moving. We're not there yet. We're not a balanced market. It's not 50-50. We are not in a 6 months of inventory situation. But when we get to 6 months, that's what's considered a balanced market. I don't know if we'll get there this year. Maybe. We'll see. But it's getting closer to being a balanced market than any time in the last 5 or so years. And maybe that's good for the consumer. Maybe that's good for the whole industry to balance things out a little bit. Hope you guys had a great time today. I look forward to catching up with you next week on the Black Hole of Real Estate.